Hello, welcome to day 12 of my training journal to help with my learning and understanding of ICT concepts. Obviously it's not financial advice because it's just in a demo environment and I'm in no way an advisor, financial advisor. Still have the flu, very ill, so but I just couldn't wait to jump back in here with the power of hindsight and come at this at these 4 losses we had in a row. It was worse than that. It was 4 losses and missing a really good trade that would have made up for it. But that actually forced me to do some more research, looking at other people who study ICT, other sort of supporting content, looking at ways to improve the 2022 model, because we saw time and time again me trying to follow the rules to get into 2022 models, and they just kept wrecking us each time. Now, one way we could have avoided this would just be to say, look at all the days where there was news, and if we just said you don't trade on the days where there's a news event, then obviously that eliminates most of what we did. But to be honest, I would probably just say, if there's news in the morning, you don't trade until the PM. If there's news in the PM, you only trade the morning. That way this would just it would just remove this one here where we took a trade right after a news event. But that would be a little bit of a cop-out, because I actually there was actually so much more stuff that the chart was telling us that I wasn't seeing at the time. So I figured the weakness in this strategy comes down to my limited understanding of market structure shifts. And I've added a new sort of concept I want to try and pay attention to, looking at the origin of price delivery. So, for example, this red box here is a daily volume imbalance. If we go to the daily chart here, what we should be doing, we should be looking at, we've got some stuff here. For example, we started here, didn't we? So on Thursday, once we saw that price was moving away from a daily fair value gap, this was supposed to give us a bullish bias, and on the basis that this fair value gap is the origin of price until it reaches sell side delivery, then it violates a bearish fair value gap, trades back into it, then uses it as support again while it heads towards the next sell side delivery liquidity. So it was originating from here, delivering up to the sell side, then it takes the immediate liquidity, then it reaches this volume imbalance on the daily time frame, rejects it, comes back away, and so now we're delivering from here. And if we go back into the 3-minute and we'll look at the first trade here, what we'll do is we'll just go to the candle before we entered in. So we're here, we were looking at this time, it was we were kind of trying to find bullish breaker reversal blocks. So we said a high, a low, a high, a low, a low. So we looked at this and we thought, okay, maybe this is the breaker then, the last up leg in price. That's fine. And our analysis is that, if this lower low has taken out liquidity and price gets above here, that's a change in the state of delivery. So we go through our rules. Buy side liquidity taken. Now this is another problem. I was I had the chart on the 3-minute here. I'm like, yeah, we're below the London lows here, so that's the buy side liquidity taken. market structure break, we kind of rationalized that, you know, closing above a swing high here is a break of structure. Not the best example of a break of structure, but, you know, fair enough. We went with that, and we saw our inverse fair value gap here, and our idea was that, well, provided that we're within a discount, once price closes above the inversion fair value comes back into it, provided that our stop loss can be at a reasonable level below the breaker, we'll enter a buy position. But that's what this was telling us on a 3-minute chart. However, once we have this volume imbalance here, marked the daily volume imbalance, we can actually see that price is delivering from that volume imbalance. You know, price, it's very easy to sort of look at this and be like, oh yeah, price is going down. It originated from the volume imbalance here. So what I've done is I tried to incorporate this concept as some extra sort of confluence that needs to be looked at when determining either a market structure shift or break. So as well as a significant low being broken and closing above a swing high, it also needs to make sure that it A, doesn't break equal highs. So for example, well, it's not in this example here, but for example, if we had, say, a bunch of like equal highs here, and when I say equal highs, they have to be to the tick, perfect equal highs. If price then comes above here, we might be saying, okay, but that's a market structure. That's a market structure shift, right? It's taken out swing highs, but no, not if those swing highs constitute perfectly equal highs, because that's a hallmark of liquidity. So that's an extra sort of concept that's being looked at. But most importantly, not delivering off a fair value gap, which actually ties back to our daily analysis, which is the origin of price. So sorry, daily or hourly. So basically this is encouraging us now when we're looking at the market structure shift to come out to, say, just a higher time frame, and you know, and well, immediately we come out to the daily time frame. We've got the volume imbalance, so we go back in here and we say, well, if it's a market structure break, price needs to, you know, not be delivering off a higher time frame PD array. You know, volume imbalance, fair value gap, the kind of, I'm just kind of lumping them in together. So, you know, that condition hasn't been met. You know, based on that, and on top of that, we wouldn't be looking to you know, trade during news events, because if we're only going to take 3 contracts a week, there's 5 days in the week. 2 of those days there are news events. Well, trading's already hard enough as it is. Why make it harder by trying to trade during, you know, uncertainty? Okay, so this here. Oh yeah, and another thing as well, if we look at liquidity. Okay, so going back to the first one, has buy-side liquidity been taken? And actually, it hasn't, because during the morning session, right, it would have been okay to look for short positions, because, you know, we come in at 8:30, we've immediately taken, you know, traded into and above the volume imbalance. We've broken the London session lows. There are sorry, the London session highs. There are no other sort of immediate highs that we can reference. So looking for short positions during the morning, that would have been fine. Then we waited until the PM session, and we said, oh, okay, yeah, the London lows have been taken, and, you know, the price is below these lows, but it's not actually below the PM session lows. So the problem with this is that let's actually put that in red. Price got really close to the PM session lows, which would be the low of well, I mean, technically that would be the low of the day, wouldn't it? But that was the news event that kind of throws us off. But we're looking at the PM session lows. You know, now that we can no longer really use London lows as a reliable sort of range to work within, we've left that range. Gets really close there and then comes back up, and it's delivering from a daily PD array. So actually, our first rule hadn't been satisfied, and now our second rule is also not satisfied. So there's two extra steps there to try and prevent us from getting in here. So now that we've got the context of it, originating from here, getting close but not quite taking the PM session low, let's see what happens. See if this makes a bit more sense. Okay, so obviously it continues going lower. It actually creates a perfectly equal low here. So I don't know what's going to happen. I haven't looked ahead yet. I'll have to wait and see what happens sort of in the overnight session. I guess we could do that now, but I'm not going to be looking at... Going to stop it once it gets to the London session. Okay, there's the New York midnight open. There's the London session. I don't want to see what the New York session is going to do yet, but I mean, it looks like it's got very, very close to those PM session lows here, so kind of looks like, that's where price is reaching for. But in any case, from the perspective of whether we should enter this trade or not, no, we shouldn't have entered it with hindsight, obviously. Okay, so now let's revisit this one here. Okay, so we're thinking 2022 sell model, sell side liquidity, taken, market structure shift, entry within a premium, premium to go to sell, fair value gap here, price above the New York Open. Okay, but where is price originating from though? That's what we need to ascertain. Where is, if we want to go short, we want to make sure that price isn't delivering from something that contradicts that. So again, we'll come out to an hourly, see if we can get some more context. So this news kind of throws us off a bit. Let's see if just going out to a daily might give us... remember, we haven't actually seen this day yet. Like, we would just see the candle once it's been completed. Well, there's this inversion fair value gap here which has been violated, and we're still delivering from this fair value gap here. So let's see if there is something on the hourly here that gives us a bit more of a clue. Well, I'm not really seeing... Not really seeing anything on the 15 minutes. Sorry, let's go back to the hourly again. Well, I guess actually on an hourly time frame we have this hourly fair value gap here. If we just kind of zoom out a bit more, there's our hourly fair value gap. Is price, where's price originating from? Where's this up leg here, this movement? Where did that start from? So we know there was like a fair value gap here the day before. So, if we were looking at it here, price had originated from this fair value gap. Price originated from when it respected, the mean threshold of this hourly fair value gap, and from there rejected it and then went up. So you know, if we wanted to go enter a short position here, we'd need to see, you know, some evidence that it was like rejecting something, but that's really kind of too far back. So the only place I can see a price originating from is from here. So you know, and since price is, I mean, we could argue that price is taking the sell side liquidity here, but we are really close to this volume imbalance, and you know, left the fair value, originated from here. It looks like it's reaching for here, so that's kind of like less confidence there. Okay, well maybe that's a bit more of a difficult example to pin down, but let's then look at all of the conditions here, see if we can get another sign that we're not supposed to enter this. So sell side liquidity taken, yes, that's fair enough. Market structure shift. This is the market structure shift here, but is it though? Because now if we go into the market structure shift here, it has to close above an old high. That's fine. Wick below a swing low. Happened here. But when it breaks the swing low, it mustn't break equal lows. It didn't break equal lows. The problem is that it did. These two lows here are unmistakably equal lows. And you know, it's quite a it's there's no explaining it away. Like, you know, these are like relatively equal lows, but they're not perfectly equal. You see there's space in between there. However, these ones are. And the risk with a market structure shift is every market structure shift could also be a run on liquidity as well, and you know, equal lows are what we look for when we're trying to find liquidity. So this market structure shift here actually looks more like a run on liquidity. So that doesn't, you know, that doesn't satisfy our fourth requirement here. Didn't break equal lows, because it did. Okay, let's go have another look at liquidity. No, I think the liquidity is fine. Yeah, it really is the market structure shift here. With these extra specifications, that prevents us from entering this one here. You know, maybe we will look to the origin of price delivery, and you know, I spent a while there, didn't I, trying to say, is price delivering from this fair value gap? I mean, it is, but it wasn't the clearest example. Okay, maybe you end up omitting that somehow, you know. Maybe you did. So then but then there's an extra requirement of a market structure shift, that it doesn't, you know, break the equal lows, so that eliminates that losing trade as well. Okay, so let's come back here to the third loss. Okay, was this a valid trade? Sell side liquidity taken. Okay, yeah, but took the London session highs. That's undeniable. But it didn't take, again, it didn't take the PM session highs. You know, once we moved out of, if we kind of imagine this is sort of like the range that we were working in, but once we move out of this range, we then need to say, okay, well, what's the next, you know, major high and low, and using the PM session there. So price gets really close to that PM session high, but it doesn't take the liquidity yet. So straight away, you know, if you don't understand the liquidity, which I obviously don't, that really is just going to wreck you. Let's go through everything else though. Let's find, where's the origin of price? Okay, well, let's move up to, say, an hourly time frame. On an hourly, we can see that price, we've got these 3 green candles. So where did that move originate from? Well, it happened here. Clear as day, 1 hourly fair value gap. Price has respected it multiple times and then, traded into it and then moved away with an energetic rally. So prices originated from the fair value gap on the hourly there. So now coming back into the 3-minute, when looking at our market structure shift, we're looking at this saying, is that the market structure shift that we can use to use this fair value gap? Is it a market structure shift? Closed above an old high? Not really. That's the PM session high. So it didn't. Did it wick below a swing low? Yes. Did it, we need to make sure, okay, it wicked below a swing low, but they weren't equal lows, were they? No, they weren't. Okay, that's fine. And then finally, it's not delivering off a fair value gap, tying back to the daily bias. Yes, it is actually. It's originating from a buy-side imbalance PD array, which invalidates us going short here. And if we now, with that context, now that we understand where price is delivering from, where the actual liquidity is, let's see what happens. Yep, keeps moving away there, and moves into the PM session highs. Okay, so right, we have this was a trade that would have been a nice trade to be a part of. Okay, so let's see if this one's valid. Sell side liquidity taken. Okay, has the sell side been taken? The London highs have been taken. Yes. The PM session highs have been taken. Yes. Since we're already outside of that range though, where's the next high? The high of the day. Has that been taken then? Yes, it has. And there aren't any, there isn't another high just above there, is there? I mean on a daily, we do have like a sell side liquidity on the daily time frame there, but we're all the way down here. It's not like we're entering a sell position, like right below it. But to be honest, when I'm looking at liquidity, I'm not looking at several weeks in the past of last month. I'm looking at prior to 8:30, what was the most significant high and low. So this is more like a daily bias thing. So significant high and lows prior to 8:30, the London high, the PM high, and the high of day. And then obviously any new highs, obviously we want it to go above there as well. Okay, so yeah, that I'm satisfied that is liquidity that's been taken. Okay, so now we need a valid market structure shift. This time, this market structure shift, we need to make sure that it's meets the new standards. So closed above an old high, yes. Wicked below a swing low, which it definitely clearly did here. Didn't break equal lows, so let's just check, are there equal lows here? Nope, not that I can see. If for example this candle was like that, we saw something like this, that would be our equal lows, so that would invalidate it. So that's what we're looking for. Okay, that's fine. And then finally, tying back to the daily bias, not delivering off a fair value gap regarding origin of price. Okay, so there is a fair value gap here, an hourly fair value gap. Obviously on the 3-minute it's not apparent. Is price originating from here? And actually, although you might say, aha, yes it is, look, it's hit the fair value gap and now it's moving away from it. But the key thing is here is that the mean threshold has been violated, and then price has violated this fair value gap by closing below it again. If for example price got to here, kind of wicked below it a little bit and then left it, then it would be originating from there, but it's violated it to the downside, and that's a key distinction. So market structure shift, this time it is valid. Fair value gap, that's obviously very easy. Problem is we had this huge fair value gap like this. Is the entry within a premium? And that would be from the most recent high to the previous market structure shift low. Little bit unsure whether to say, that high or this high here, but the key thing is that it's to the most recent market structure shift low. So if we were entering here, this would be what we're looking at, but then price makes a new market structure shift low. And then we use the previous high. I think it kind of either or, but if we use the previous high, we have a more conservative target rather than if we did this, because if we put it to the most recent high there, considering we're kind of entering this move a little bit later, it gives us a more conservative target, sort of lines up with a PD array. Price is above the New York Open, yeah. So then we have to kind of address this issue here, because originally we were waiting until after lunch, weren't we? Originally we did something like this. We wait until lunch. We need to make sure that this fair value gap is violated, so that it's not, okay, so it violates it. So now we're looking at this fair value gap, but here's the problem. This stop loss is the maximum 18 pips. And if we enter here, we know that price may want to go to the mean threshold of the fair value gap. In fact, it almost definitely will. And the stop loss actually needs to be above a swing high. So that actually kind of presents a problem, because even if it respects the fair value gap, it's still going to stop us out. So what I actually decided to do was that I was going to wait until the actual PM session, and then since price had already traded into the fair value gap, what I decided to do is I decided to reduce it to there, and then say at least this way, if we enter here, we've already given price a chance to kind of trade back into here, so, and that kind of shortens it. Kind of necessity. I mean, obviously it would be nice to sort of have infinite risk and do something like this, and then but obviously we can't afford to do that, because you'd have to be losing. Yeah, you'd be taking a lot of heat. Also, the problem is if we say that the stop loss has to be at the swing high, that's also not gonna do it. Maybe if the fair value gap is too big, we could aim for like the mean threshold. That's a kind of reasonable thing to do. You put the stop loss at the mean threshold of the fair value gap. Most of the time my stop loss is able to fully encompass the fair value gap, and sometimes even the swing high as well, the body, sometimes even the wick, but in this case this price movement is actually more like something like this really. So I figured I would just wait until we see how far price trades back into this, and then we could either use the mean threshold, or we could just enter the part of the fair value gap that hasn't been traded into. And then yep, and then price, you know, let's just say we stay in this. We're looking for when to get out, trade invalidated if it fails to break an old low. So price comes up, makes a retracement, it's going to come back down. Okay, it made a low, it's going to come back up again, it's going to make another swing low. And as soon as, I mean, at this point here, we're like 100 pips in profit. I think any normal person would put the stop loss to break even. As soon as price, yeah, okay, there we go. Failed to break a swing low. Stop loss to break even. Up close candle violated. That happens here. Okay, so now we put move the stop loss to the previous high, because if price now goes above there, it's making a market structure shift. Okay, so now that's where our stop loss is. You know, because there's still a chance the price could go down lower. Okay, it's made a new swing low. You have to remember at this point we're in 140 pips of profit, and you know, the compulsion to close the trade would be immense at this point. So what I'll probably do at this point is, you know, since we failed to break a swing low, had an up close candle violated, we put the stop loss at the high, and then each time a new swing low is made, we then start trailing the stop loss down to the previous high, and we'll kind of just do it that way until we get stopped out. Oh, well, there we go. PM session is over here. Not trading past 4 because that's the end of the PM session. So if we haven't hit our target by then, we'll just put the target there. And that's kind of a... Oh yeah, and then finally the last losing trade. Let's look at this. Okay, so we're looking to sell. Has sell side liquidity been taken? London highs have been taken, yes. PM session highs have been taken, yes. And the high of day, it's even wicked above the high of day as well. So I'm going to be honest with you, I would consider that liquidity being taken. Okay, fine. Has there been a valid market structure shift? Closed above old high? Yep. Wicked below a swing low? Yes. Did that swing low contain perfectly equal lows? Nope. Doesn't look like it. Okay. What about the origin of price? We need to make sure that price isn't delivering off, say, like a higher time frame PD array here. So, okay, we'll go to the 1 hour. Not really seeing anything here, you know, so I mean, I guess we could look at the daily as well, try and take our daily bias into consideration. I mean, at this point we haven't hit the... Let's have another look at this. I mean, no, we've taken the liquidity. This meets all the conditions of a market structure shift. You know, just trying to explain it away, but I can't see anything that, you know, invalidates, you know, at least on an hourly time frame, I can't really see price rejecting off of, say, like a fair value gap or anything. No, that's okay, fine. So next, fair value gap. Yeah, we have the fair value gap here. Is the entry within a discount? Yes, it is. Priced above the New York Open. Okay, well that's fair enough. You know, I had those extra rules. Okay, so it doesn't prevent this one. But that's kind of good because it doesn't disqualify this trade because, I mean, we were making a prediction that once price got to here, it might go up a bit more, but then ultimately it would go down and reach into here. So we were kind of bearish. So while, our stop loss, unfortunately price came up a bit more. So this is, this is like an honest loss. It's fine. The losses do happen. It's the other losses that could have been prevented if there was more sort of like reasoning behind them, more contextual awareness. So, so we had, 4 losses, using these rules, eliminated the 3 of them, on top of eliminating 1 of them if we say no taking trades within the same session as an economic calendar event. So the challenge now is to be able to trade live and try and have the same level of awareness of what price is doing as we have when we come back in hindsight. So the more of these examples that we go through, the more likely it is that we'll be able to analyze price as we're doing now, but without the benefit of hindsight. So that's the ultimate goal. So in the next session I'll go forward again, try and apply this as best I can. I'm sure I'll miss something, but I think I need to spend more time, because on one hand I don't want the recording to last too long, but on the other hand I need to give myself enough time to really consider everything here, because there is a lot to consider. There's daily bias, there's lots of different factors. If all you do is just on a 3-minute look at highs and lows, and and you don't have a wider understanding of what's happening on a larger time scale, as we've seen, we could just get absolutely wrecked. And but yeah, I think some more understanding has come out of that difficult streak there. So yeah, I'm going to wrap things up here, and thanks for watching. Let me know if you have any questions. Bye.